A very warm good morning to all the participants here. Thank you, Mr. Nishant, for accepting our invite today. We had got so many requests to take up, certain different techniques of valuing startups, because so many startups are coming in and they are getting funding and they come to us for valuation. So we'll still be grappling as to whether DCF is fine, not fine, whether any other method could be explored. So that is why Mr. Nishant has chosen such an interesting and challenging topic. It's my privilege to introduce Mr. Nishant for the audience. Mr. Nishant Soni is a business valuation specialist. He is a registered valuer recognized by Insolvency and Bankruptcy Board of India. He is also a diploma holder in IFR by ACCA, United Kingdom. He is the member of Committee of MSME and Startup of ICAI WIRC. He is qualified as a CA based from Mumbai. He has been dealing in specialized cases of business valuation, due diligence, and structuring deals for startup companies. He himself, we welcome you, Mr. Nishant, and we would also like to hear from you. What is this Committee of MSME and Startup of ICAI WIRC? It's very interesting. Throw some light on this, please.
Yeah, sure. Thank you so much for the introduction. So, WIRC is technically a body which is governing Western region of C Institute, and for the development, we have been nominated as a member over there. So the idea or the agenda of the group is to promote MSME, give some representation to the government bodies that whatever problem they are facing. So based on that, the government can take action and implement certain better things. So this is the whole agenda of the group. We meet twice in a year, but then with a lot of information inputs that we gather, because we've been working with startups, etc. So that's why we gather the data and meet with the committee, make a draft, and then make a representation to the government. So anything is still welcome. I mean, from your side also, as a whole from a committee. So it would be good to make a nation a better place for business, reduce compliances, and focus on business.
In fact, many of the valuers have a view that, that maybe I'm not seeing the other side of the coin. That's always there in the valuer's mind. Maybe, I'm biased, or am I biased? What is the other side of the coin? So as you're an angel investor, you know both the sides of the coin. So I'm sure the audience will be getting more value addition in your today's session. Over to you, Mr. Nishan.
Thank you so much. So very warm good morning to every one of you on Saturday morning, and indeed so much thankful to you for joining for today morning session. Morning is the best time to study, to discuss. It's disturbance free, and you have no phone calls during this time. So I think the best time to explore things. So maybe virtually also. So thank you very much, Bangalore Value Association, for providing me this opportunity. So I'll share my screen and we can quickly start learning.
This time is also best suited because all other professionals might be attending other CEP sessions, as they are also CAs, CS, and CM.
Right. Okay, my screen is visible?
Yes.
And my voice is okay, loud, right?
Yes.
Okay, chalo, perfect. So let's tune into this. So the idea was the startup valuation was something majorly that we wanted to cover. But the thing is that just understanding startup valuation may not be suffice. For that, we have to have a background for startup, how it started, what was the journey, what is the government's intention, what is investors' intention, what are regulators' intention. So with all these things comes up a valuation. So these things are something which automatically has been derived into the market. It is not something has been invented by a particular person. It is how the market has reacted on startup, and based on this the evaluation has come up. So that is the thought process to take up the topic a little bit more in detail, and that's why it's navigating the fundraising landscape. So fundraising means what are the prerequisites if you're investing into a startup, from investor side, from regulator side, what are the startup valuation methodologies that are going into the market, how things are looked by the startup, by the investors, or by the valuers, and then other types of deal instruments, whatever is been issued by the companies, startup companies. So we will be taking a short view on that also. So this is my plan for the next 2 hours. Just 1 second now. Okay. My screen is properly visible to you, right? I am having some thing.
Yeah, we can
It's fine.
It's fine. No? Okay, chalo, great. Yeah, so these are the things that we are going to cover in detail. The fifth point is something I've just added as a bonus to all of you, that in case a valuer, because as a valuer, we normally focus on business valuation, but the thing is that we can give some more services to the client, to the startup field. Startup industry is quite big. So in that case, I have just added the art of pitching. So in case a pitch deck is also being required to be prepared. So what are the things that you need to incorporate in your deck? So if time permits, I will take that. Otherwise, I'll just keep as a bonus when you'll be circulating my PPT to every one of you. It's well elaborated over there. So this is my plan for the next 2 hours, and let's begin. So the investment landscape. So what is startup? First is, we know we are with the topic of startup valuation, but let us understand what is startup. So startup is a private limited company, LLP, or registered partnership firm. I repeat, registered partnership firm, which fulfills the criteria that it is not older more than 10 years. It's not formed by splitting up or reconstruction. Okay, so these are like broad criteria. So the question is, it's like mentioned whether it's a private limited company, LLP, or a registered partnership firm. So definitely unregistered partnership firm is ruled out. Okay, sole proprietor firms, is it allowed? So maybe we can make it a little bit interactive. Chat box, I'm just opening to see. You can also reply me or ask your questions on chat box so we can see. Right. So whether sole proprietorship is allowed to become a startup just to get a DPIIT registration?
No, sir.
No.
Right. Perfect. So it's not allowed. And whether the conversion process is allowed for them or not. So if it's a private limited company, maybe, the person comes in at early stage and opens a LLP, and then he thinks, okay, I have to convert into private limited company because I really actually have an idea, but because of compliance purpose, etc., I formed an LLP. But the preferred mode of the investment of the investors into a company is always is a company only. Startup is better if it is a company, right? Because there is no process of keeping your constant percentage. So percentage it keep always getting diluted as and when new investors comes into picture. So that's why company is the most preferred option. But at the same time, is OPC allowed to be recognized as DPIIT startup registration? Is OPC allowed? It's a question to you.
OPC is a private limited.
It's a private limited, right? So
it's allowed.
Yeah, so it is allowed. So perfect. That's great. Right. So conversion process is allowed. We will just take up in the next slide in what ways or how this can be functioned, or what are the problem or challenges. So that will just take up in the next slide. So in meanwhile, turnover. So if any startup is exceeding its turnover above 100 crore, it will lose the tag of DPIT startup. So it's a like matured company. Why 100 crore? I think this is kept in similar lines to MSME thing. So MSME registration is also that micro, small, medium enterprise. Up to 100 crore only, you're recognized as a medium enterprise, but after that you are treated as a large company. So similar with the startup. So they've kept a turnover of 100 crore. What is turnover now? What is the definition of turnover? So will my if I'm also doing some more business into my company, so what is the definition of turnover? So the turnover definition given in DPIIT is that they've considered equivalent to section 44 AB of Income Tax Act 1961. So they've said whatever is the business turnover that you're reporting in your ITR return will be considered as turnover. So there could be a view. Some people have a practice of taking. Some practitioners take income tax. Fixed deposit income as interest income from other sources. So that may be probably excluded if it is in income from other sources. So at the same time, there's one more section 145(2) of Income Tax Act, which says that you need to follow Indian ICDS, income tax computation disclosure statement, right? So that also needs to be incorporated when you are calculating your turnover. So that's how the DPIIT website speaks about the definition of
Mr.
turnover.
Nishant, I have a request.
Yes.
Since the audience are more valuers, you can just slightly touch upon and move to the exact valuation aspect of it, because 2 hours will just, it's such a short time to cover so many points.
Yes, no worries.
We had this
No worries.
session earlier also on this
Okay.
topic.
Okay, great. So the last point is innovation is required. Development or improvement of product, process, or service has to be there, and there has to be a scalable business model in terms of employment generation or wealth creation. So if any of the three conditions satisfied, then recognized with DPIIT startup registration. So quickly touching upon the things that in case there's a change in the shareholding pattern. So as per the guidelines, Indian promoters should have minimum 51% holding with him. So now this 51% will have some more study effect in our future slides. So we have to be careful that 51% should be at least held by the promoters. Okay. So other things, if there's a conversion process happening, like there's a change in states, change of the registered office is shifting to other state, then in that case you're allowed to continue with DPIT registration. And if there is any change in industry or sector due to cancellation of existing certificate, so like for example, a company got incorporated earlier in your JIT fund type category, but now later they are converting themselves into an NBFC. So there is a change in the licenses. So still the DPIT will continue to be recognized for those kind of startup. So you cannot incorporate any additional entities with common director or partners or partnership firm, something like that, as a subsidiary company. It will not be treated as startup. So moving ahead, the important is the landscape. So the only one particular reason I'm included this particular slide is to show you that the number of deals have been coming out every year. From 376 deals to 9,995 startups have raised funds, and in the last year 2023 they have raised about $146 billion. So startup is actually a very big industry. And the reason to include this slide is just to throw lights that from 2020, 21, 22, at this year being a COVID year also, there is no recession in this particular industry. So as a valuer or as a practitioner in startup, you can always, focus and work more in this particular domain because it is still inching up more and likely to go still beyond, with the vision of the government to taking it now not only to $5 trillion economy, which is almost about to achieve, but to 45 to $50 billion dollar economy, trillion dollars, sorry. So some biggest funding which has happened, probably the biggest till now is a $3.6 billion investment in Flipkart. So other things are there for your display, but the point is the potential to value such companies is huge. Now, how to value such companies is also a very big challenge, and it cannot be a 1 day, 2 day exercise. So there has to be something more towards it. The views, the concept of the business, the IPs, etc. So all these things would matter a lot. So that's what we are going to cover subsequently. So what is funding? So when we say it's a startup, as a startup, there are multiple things attached to it. So one is the stages of funding. That is, typically we understand that every startup is different in its nature, in its size. Some are pre-revenue companies, some are just at incorporated level companies, Some still have a business idea, they've worked on it, they've developed a prototype, but the company is still not yet incorporated by them. They think once we get an investor, then we'll start incorporating a company. So the stages could be different. And at the same time, some companies have already raised funds and they're looking for further raising of funds. So there could be different categories. Different types of investors. The investors also have a typical mindset when they're coming or investing into a company. Some sees they want to find value discovery. Some view the company as we want just scaling of the business. Some feel that it is the best time to come in the bad times of the company when they're not performing well, and then when we come enter into the company, that time we can strategize and make things better. So everyone comes with a different angle and different thought process. So the investor also have a lot of values to it. So investors mindset also determines value for the startups. Types of instruments. So the company has an option to raise funds via equity or via debt. That's broadly what we understand. So these are the two options in which they can raise funds. So in equity, there could be equity, CCPS or CCD, right? In debt, there could be loans, there could be deposits, there could be debentures, etc. So we'll see more what are the options, and depending upon the instrument, we have to understand what kind of valuation we are going to perform. Finally, the valuation nuances, that is your ask versus fair value. So sometimes the negotiation also happens. So that also part will be covering in detail. So let us start with the stages of the company. So typically a startup is distributed over a 6 stage. So, and from valuation perspective, we have to understand at which stage the company is, and accordingly we can act or react with our modeling part or our methodology part or selection of the right value for the company, a fair value for the company. So when we say it's a stage one company, it is typically at a very, very preliminary stage. So there is no revenue and hardly expenses also. So it's like 1% type of company, one or two management person might be there into the company, and they must have just formed in company. So here typically when the company is at an initial stage, normally it is a friends and family round. Typically we say that it happens that the friends and family are supporting the project, and that's how they secure funding. Then stage two is towards your beta stage, when your prototype something is ready. So at that point of time, again, since you are only ready with the product, so again at that point of time there is no revenue into the company, but the expenses have started coming out. So typically some management expansion also happens, some hiring also happens in this particular case. At this point of time, majorly the angel investors or early stage venture capital companies enter into the company. The third stage we can say is beta stage, where there is no revenue and significant kind of expenses. So there's a complete management, the management is totally completed, and you have good amount of people also running into the things. But these are just like they started promoting their product or services, and they're about to just enter into the market. So that is the stage three. Stage four is they've started executing, billing have started, but they're still slow or low, and they're like upcoming. So for them to continue, most of the time bridge round of loan is required to be executed. Then you have a little more established company, and probably at the late stage startup, so they have more executed or are more properly working. They are almost crossed the break even. Okay, so that's the cash burn etc have stopped. So they are now at the final stages and looking for an IPO type thing or giving an exit to the investor. The stage six is an established company, so like Reliance, Tata, etc. So it is reached to the maximum level. They are self-sustained. They have nothing more to do it. So that's how the startup company has a concept of reaching from zero to the aiming at listing of a company. Typically, at the initial level, a seed funding happens, which is from the close group of people or angel investors or incubators normally put some funds into it, and then as and when it keeps growing, So
Nishant, again, a request to you, the audience are experienced valuers. All
yes,
these are basics which we have covered in many other occasions. The
okay,
actual techniques or the actual thing, valuation, these are like mostly the audience are aware of the basics. You
okay,
can go to the actual valuation discussions and take it interactive at that level. This is too
okay,
basic for the audience.
okay, sure. ठीक है. So this also I can skip investors type, etc. So
Yeah,
everything
because
is
these are seasoned valuers, right? Since
right,
almost 5-6 years, they are already valuing.
right. Okay. Yeah. So when it comes to valuation part, we have to understand equity shares is one category, CCPS, CCD is another category, convertible notes is another, and venture debt is another. So these are four things like typically which is to be valued. So details, I'm not going into it, but in very broad level, each and everything is to be treated little bit different in terms of valuation. So how that will come with the methods, etc. So I'm skipping these parts. So there's a equity shares, CCPS. So regulatory, etc. Here, I think I'll just highlight a particular things. When CCPS is being issued, at that point of time, one has to definitely check that it is not more than 20 years. And at the same time, if conversion price is not determined at the initial level, it's okay. As per Companies Act 13, it's okay. You can value it at the time when you're trying to convert. So that's what the Companies Act 13 says. But when it comes to FEMA has clearly prescribed one particular thing. The conversion price or the formula has to be determined upfront and which cannot be less than the fair value at the time of issue. So giving you here two simple scenarios that a company has issued a CCPS, all are resident investors. Okay, so in that case, we can probably say that the conversion may happen at a future date. That's okay. You can write in a valuation report and give it. But I think because MGT 14, when you're filing, we need to give the report at the early stage. So typically we give a report stating that the terms of conversion, if anything is determined, in case it is not determined, we clearly mention that it will be determined at a future date. Okay. At the same time, but when it is FEMA, when non-residents are also coming into your things, at that time we clearly mention that fair value is required. So it is better you have a floor price ready for it. So if floor price is ready, so that means that your base price is ready. So based on the floor price, you have to give a valuation report. Whatever valuation comes out is your floor price. So that is the minimum conversion price. Over and above that is something that you can decide that next round discounting is 10% or 20%, etc. So these all things can be managed.
Just a small query here. In FEMA, you said that the floor price gets mentioned. But if I am the regulatory authority, I will not know that this is the floor price. So any clarification letter gets attached to FCGPR?
No, so here typically what we do is we write the floor, the valuation report, whatever the valuation comes out is the floor price, which is treated as a fair price today. So the law says that which cannot be less than the fair value, right? So when I'm issuing today, my fair value is say X amount and X amount becomes a floor price. So over and above that, FEMA also allows me to convert. Okay, so say example, I am doing a business valuation, I get a value of 100 crore rupees. So 100 crore is my fair value. Okay, so this becomes my floor price. But in case next round is happening at 200 crore valuation and they're saying you get a discount of 20%, etc. So over and above floor price also, if I'm converting, there is no issue. But then this is a formula that your pricing is dependent on a formula also. So that formula is also to be mentioned into the report that this has been proposed by the management, but according to us, this is the floor price. Okay.
So just to add there, Shilpa, we actually when we give the valuation report, right? We generally give it at the floor price and the conversion at the floor price. That is generally provided. As long as the speaker said is it meets the minimum requirement of the FMV, it's okay. But we generally give the conversion for the floor price.
Correct. So conversion ratio may not be mentioned immediately. So like what I can say is you can give a report of a floor price And then at the below that you can write, so you can make a table and give them understanding that in case if it exceeds floor price, so then they're allowed for some discount over the next valuation round. So that things can be mentioned very well into the report, and I think that is getting accepted also, because the concern for FEMA authorities is only one particular thing, that whatever is your floor price, you have to issue report, you have to, give a formula that it is this is the floor price, and beyond this I'm not able to, below this I'm not going to go. So there's no loss of forex to the country. Okay, so
There's a
that's the
question here.
only-
There's a question here. What if the reverse happens? And that is pretty much true in case of startup. The startup raises money through CCD from a foreign investor,
Hmm.
and the X floor price was decided.
Hmm.
But after a couple of years, the startup has almost lost operations and everything, and now the conversion is due. So what happens in that case?
In that case, you have to, if you are a non-resident investors, then you have to continue to adhere to your this conversion formula, that you cannot go below floor price, because at the time when you had given money, at that time the floor price was determined, that was your fair value at that point of time, so you cannot go below that.
No, but now when the conversion is happening,
Hmm.
do I need to get a fresh valuation report of current date?
For FEMA purpose, you are telling?
For FEMA and ROC both, because now when the conversion is happening,
Hmm.
I need to file the
So say it
form with the
depends.
ROC data.
Okay, so it depends. So in case of ROC, if you have not taken a valuation report earlier, so if prices are not the conversion ratio is not determined earlier, so you have to take now, because you're converting it into CCPS to equity. So at that point of time, at point of conversion, you have to take. But when it comes to FEMA, typically yes, we have to take both the times, because we are issuing uh, another new set of equity shares. So if you have given a formula or something like that, some milestone type of things, so in that case, because the communication was not very clear earlier, so we suggest to give it now, because in any point of case, like in case next round is happening, you're already taking a new report for the fair valuation at that point of time. Okay, so then in that case, if you're getting a discount to it, okay, so the question is which report to give. So there are like one is 200 crore round, one is a 160 crore round. So which report I'm supposed to give? So in that case, we give 200 crore valuation report only, but 160 crore is something written by the notes by the company to the FEMA, not as a valuer. We need not do anything, but the company has to write to them explaining about the discount which was agreed upon, which is over and above the floor price.
Actually, Mr. Vijender Singh, if I have understood your question correctly, in one of my clients' case, this was the requirement. Already, in fact, what Mr. Nishant is telling, where the conversion price is not agreed. But in my case, conversion price was agreed. There was a floor, and then the company has lost, almost everything. So now the conversion is happening, but the company, I don't know whether it's right or wrong. I request the audience to correct. There will be a new valuation agreed. New valuation report will be issued. The CCD agreement will undergo a change. Proper approvals will be taken in the shareholder board meeting and everyone else, including the CCD holders. And then we are proceeding it. So the new conversion price will be agreed and the new valuation will be agreed. So just request audience if anyone has a similar experience.
Yes, right. You have to change the shareholder agreement or the terms which was agreed upon earlier. So in case that is been approved by all the members, like including general meetings, etc. approval, so then you have a right to change the terms of conversion, and accordingly you can avail a fresh valuation report and refile it things. That is also possible.
In FEMA is something, I'm still not, in my case, it was a resident, so I didn't explore. So anyone has any experience how in FEMA, because earlier we would have given one conversion price. Now it's changing. So how the FEMA reporting happens? Anyone has any idea?
So,
Because as
Shilpa, actually, during that valuation marathon we had in December, right? We had one of the participants raise something very similar to the speaker, and we had a discussion on this. So we were saying that, see, you have issued an instrument at an early stage and it has been supported by a valuation report where the threshold valuation has already been mentioned. So subsequently going back and trying to reduce the valuation, don't you think that's like a violation of PEMA requirements that has been brought in? So because obviously you're getting more equity, which goes against the premise. You probably have a reasoning towards why you're getting more equity, but there still remains a concept that it is you are getting more equity than what was actually promised. So in that case, we were actually discussing, can we look at alternative instruments or some other mechanism to structure the transaction rather than try to work on this number of the conversion ratio and straightforward adjustment is what I vaguely remember as the discussion at that point of time.
Thank you, Maitri. Anyone else has any answers, or we can proceed, Mr. Nishan?
Sure. Okay, so moving forward, here, okay, this we can cover while we're taking the formulas for CCPs and CCD. So a concept is simple that what is pre-money valuation, my investment and post-money valuation. So when we say pre-money valuation, typically in the example, 9.5 lakhs is my capital and 5,000 is ESOP. So 5,000 into 10 rupees per share gives you like 50,000. So in this case, 10 is my pre-money valuation. In that case, I'm getting an investment. So my post-money valuation will become 11. Okay, so the concept of pre-money has to include your business value plus unallotted ESOPs also, which is proposed to be issued. But in ESOP, just, we take care of one more thing that the management says that ESOP is a pool of ESOP is created by them. But I think we should even check for approvals, whether it has been passed in board meeting and general meeting, etc., that they have a proper approval or not. So I think once we see that approval is also available, then only we include ESOP in pre-number of shares. Otherwise we exclude. Okay. So
yeah, Nishan.
Yes.
So related to this ESOP, so have you considered the total ESOP pool available for computing the total number of share or the ESOP granted till date?
No, total pool of ESOP which is going to be allotted even in future. So because
but if they have not even granted, then also you count it.
Yeah, but they're going to give it to the employees in some or the other time in future. The reason is, see, dilution. Dilution is actually covered a little bit more in detail in future slides. But then again, keeping the conversation open, the ESOP pool is something affects the dilution of the investor. So investor wants to know at beginning itself that how much amount of ESOP you're going to allot in future to your employees. So otherwise they will keep increasing the ESOP pool quota from 5%. They may one day come down to 20%. So the investors' dilution is affected actually. So that's why investor says, you tell me now only upfrontly. You're going to allot 10,000, you allot 10,000, no problem. Create a pool. So 10,000 shares will be there. Now you have not even allotted a single, that's also okay. You have not granted any, that's okay.
Otherwise, what happens, Nishant? Like if we say what the other professional was trying to say that no, you can't take. What happens is there is a set of term sheet which has certain valuation, certain ESOP pool, and then certain issue price. Say for example, and then you have valuation report coming to the same value, coming to the same issue price. Okay. But that ESOP pool is not considered. So somewhere there will be a mismatch of all the documents, both showing the same price, but then ESOP pool is considered in one, ESOP pool is not considered. So it looks more evident, there is some, miscalculation somewhere.
Absolutely. Yeah, because the ESOP pool which is available, which is the company is going to grant the max ESOP in the lifetime. That's the pool they have created. But now if we consider at the time of the valuation, even though they have not identified the employees, they have not even granted the letters. I don't talk about the exercise, but even they have not granted also. Then also if we count it, then income tax or some authority might also raise the question that you have increased the price because you have considered this in denominator.
Price has reduced because the number of ESOP is reduced.
Yes.
So the thought process from regulatory point of view, you might be valid, but this is from investors' point of view that investors want to protect the dilution. So when we speak to investor, when we speak to certain fund houses, they want a clarity at beginning itself. This is like investors angle that they don't want further dilution. Okay, regulatory wise, like looks like what you're saying is correct. I agree that the regulators might object that this is not the total number of shares you propose. So that's why uh, maybe a document or midway could be that if you have a document from investor from the company that they have taken an approval in general meeting that they're going to allot this much number of shares, so then you have already submitted one document to the regulatory that these many number of shares I'm proposing to issue. I've created a pool for it. So again, ESOP works in two ways. One is uh, how the pool is created. Either one option is the promoters transfer his own shares to the pool. Okay. The other could be this open a trust and issue new shares to the trust. So I mean, depends upon the case again. So in both the cases, if promoter is only transferring the shares, then your number of shares will always remain same. If promoter is only giving shares to the employees, but if it is the other way around that you're going to issue new shares in the trust and the trust is going to allocate such shares to the employees, so in that case you're definitely issuing new shares. So sometimes those shares also kept in the trust unidle, but it definitely has a value. So maybe it's not yet subscribed, but it will be again given to the employees at throwaway prices, and that's how the ESOP works. So it will happen. So in that case, again, I mean, we can include it in the total number of shares because we have a board resolution and approval in general meeting that they are going to be issued.
Another way of looking at it is just that it is like a CCPS or something. When we consider it is on fully dilutive basis, even those preference shares are not converted into equity, but we consider them that they will be converting in future as equity, and we include in the dilutive equity, dilutive number of shares. Similarly, ESOP also has to be considered with the objective that this will completely get subscribed into equity shares on a future dilutive basis. So this is from the investor perspective. Completely it has to be taken, but regulatory perspective also this can be substantiated, and the logic here is on a dilutive basis. We are writing the basis that the value per share is on a dilutive basis, and that takes care of this, is what is the opinion.
No, but sir, ESOP, CCPS, in that case, the instrument is already issued. Here we are talking about the ESOP, which is not yet granted. The employees you are not identified. There is nothing on table. It's only that the company has set aside the pool. There is no instrument yet. CCPS is an instrument having the terms and everything in place.
To add to the justification for considering the entire pool is that because of the pool being existing, the company is able to retain talent, attract talent, and because of which the employee costs, the actual employee cost would get reduced in the future cash flows, and and this would go on to reflect in a higher valuation. Basically, the enterprise value will go up because of reduced costs, and that's the reason to match this this increase in valuation, the entire ESOP pool is considered, and therefore we will be able to. I mean, basically, it's a matching concept. Even in the numerator as well as in the numerator, we consider the in the numerator we consider the benefits of ESOP. In the denominator, we consider the entire ESOP, and that's probably a small note regarding this might give a bit more clarity.
But sir, your cost is not going to decrease because you are anyways going to make the provision for the ESOP expense in your projection. Because whatever the talent you are going to retain it, you are not paying them in cash form, but you are paying them in ESOP form. So ESOP is an expense that you are going to project it. So there is no higher profit or higher incremental profit or revenue you are going to get it.
Precisely, sir. When we have considered the ESOP costs in the future cash flows, we would have considered this particular expenditure in the numerator. And moreover, this ESOP cost, had this ESOP cost not been there, then the actual cost of attracting the talent and retaining talent would be even higher. So considering those, both the numerator as well as denominator would be matching, is what I thought.
So I think I focus more that in case ESOP pool is there, no, so there has to be some document to it that the pool has been approved by the investors by the board meeting, and it is also been taken approval in general meeting. So if we have that document, then we generally consider ESOP. If that is not there, then we actually say that it is just your thought process. So we don't know. So then in that case, we may or may not take it depending upon discussion with investor. Okay, but regulatory point of view, I think it's absolutely valid that we do not have a justification of the supporting. So whether to take it or not is a question. But I think some of the examples given by the audience over here is that maybe, I'll put it this way, that EPS, when you're calculating EPS, you take all potential number of shares to calculate EPS. So there's a basic EPS and diluted EPS. So same way, we also have a practice of taking diluted equity number of shares. So in case you're taking an ESOP pool or you're not taking an ESOP pool, I suggest write a note, elaborate it very well in your report that on what assumption you have taken it. So if it is purely based on the investor agreement, please mention it. So the reader of the report is clear that this is how the view has been taken for the ESOP adjustment in your pre-money number of shares. Okay, shall we move forward? So CCD is similar. I think the discussion is very much in lines with CCPS and CCD. The conversion tenure is 10 years, except in CCPS it is 20 years. So to be very honest, I have found one case that conversion period was, I think, mistakenly written as 20 years in the CCD agreement. So my team had also valued it, but then we verified it that it should not be more than 10 years. So law always overrides. So just ensure that 10 years is always the maximum tenure for a CCD. It's very rare mistake, but still I found it.
There's a question for CCD.
Please.
When we issue the CCD for a startup,
Mhm.
so the problem comes for the valuation requirement, because usually if the conversion ratio is fixed, then the valuation report is required for the equity as well, right? But the problem comes from the regulatory, from the ROC point of view, that debenture itself is a security, right? And if you don't, even if you don't have the fixed conversion, you still have to have a price determination mechanism.
Correct.
Many of the profession says you need a valuation report for the CCD, whether it is 10 rupees, 100 rupees or whatever. But
Yes.
that is not determinable because there's no security premium element. So if you say 100 rupees face value and you say the value of CCD is 200, it doesn't make sense.
Correct.
So the problem is, how do you address that? There is an option in the form itself, the ROC form, where you say that valuation report is not taken. It will be taken in future, and you can just give a reference of Rule 13(2)(h) in the form itself, and the form gets accepted. But whether that is the right approach or something is getting missed out.
So typically we issue a valuation report only. The valuation report may not. So in that case, so two things. One is the management has proposed that they want to issue a face value of 1,000 rupees, 100 rupees, 10 rupees, whatever. I mean, that is management's call. That today they're issuing at so and so face value. Okay, the value per share may be totally different. It's okay. So that's management call. So we write that management has proposed that they want to issue at 1,000 rupees per share, whatever. At the same time, what we make one more annexure into the report, and the annexure states all the terms and conditions with respect to the debentures which has been proposed to be issued. So in that case, we cover a lot of things like whether the option of conversion is available with whom, with the management or with the investor. What are the terms of conversion? So if it is convertible at some fair value, I mean the formula, if possible, to be put. If there's no formula, then clearly stating that it will be determined the next valuation round. So if there is a next valuation round, is there any definition for qualified round, etc.? So all these things, definition, we make a separate annexure for it, and whatever maximum information is available with respect to valuation, we write it as an annexure in a table, and then give a valuation report in that case. So that's the practice.
But how do you value it?
We are not
How do you value
valuing.
it?
We
You
are
value
telling that
face value.
management is proposed at this face value, they're issuing it. So annexure will just speak if conversion clauses is there or not. So here, from valuation perspective, I think the more important thing is conversion. So at what price they're going to get converted in future is something the interest either of the regulator or of the investor or anyone, I mean. So conversion has to be
That's
put into focus.
that is fine, that we accept. But the conflict happens when a lot of professionals say that since a debenture is also a security defined under Section 42 and it has to follow the same rules of private placement, you have to value the debenture also. Now that becomes a problem, because how do you value? Because it's ultimately it's going to get converted at an unknown price, and 13(2)(h) rule says that you can get it later on, right? But
Yes.
the value of that instrument itself, how do you, first of all, whether we should have a valuation report on that or not, that is one question. Secondly, if the valuation has to come, how do you value it? Because it ultimately has to come at the face value only. If there is no conversion disparity yet.
Correct. No, absolutely right. It's a very practical problem, and that's what I mean. We have been addressing the same way that first, to answer your first question, valuation report is required. Yes, there are many startups, their advisor advising to take it. There are company secretaries who are advising to take it. There are even big fours are advising to take it. So it is like valuation report is mandatory. Okay. Now, when valuation report is mandatory, in that case, the question is, as a valuer, how do we write that 1,000 rupees is the face value at which you're issuing? So the face value is something described by the management, is what to be written into the report. It is not our opinion, it is management's opinion. Management has proposed to issue at so and so value, and the conversion terms is stated in annexure. So in annexure, you're writing conversion has to be at fair value at a future date, giving reference of the rule you said 13(2)(h). So based on that, a reference can be drawn, and an opinion can be. I mean, the drafting skill is essential over here to say that the act says you are allowed to value at the time of conversion, and taking benefit of that section, we are using this particular valuation rule. So overall, I mean,
Alternatively, but if the same thing has to be done, alternatively, you can just, in the past 3 form, you can choose valuation report has not been taken and this is the reason for it. So will that approach be right? Or stating that no, management has proposed this value and we are signing off it, that is more appropriate.
that approach is right, but in certain cases of due diligence, when due diligence was being conducted by some of the investors, they have requested that you don't have a valuation report for this particular thing. So in order to avoid conflict, I mean, people are also taking valuation report, because as a startup, they are more concerned with the funding that they are getting, and they don't want any problem in future due diligence process. So that's why, I mean, they have been always taking such reports.
Yeah, one point to add here. So I agree with the first point, but the second point, when we say we are doing the valuations and submitting the valuation report based on the value which management has decided and issuing the same, it's a little debatable, because when we do the valuations, we can also key in the factor of interest, the coupon rate at which the debentures are issued, whether it is a fair coupon rate or not. Otherwise, if we take a fair coupon rate and do the present value of the future cash flows, so we may arrive at a different value. So if it is issued at discount.
Here they are talking about convertible, no? That is the whole point. Convertible is there and conversion terms are there, not redeemable. That's the whole point.
Yeah, that's the whole point. But in the conversions also, if it conversion also happens at a future date at face value, then what? So because it is unidentifiable. So some calculations we have to make, and some calculations we have to attach to it, basically, that we either we are making a floor price of conversion also should not be happen at that over and above. It should happen over and above. Whatever the benefit of the interest has already been taken by way of debentures, the conversion should not happen below that price. So that was my point actually. So valuations will have a specifications in terms of mentioning the fair price.
So if that is like
Also, the problem is that if you go for this CCD valuation or a optional convertible debenture valuation, another problem comes when once is that you value the debenture debt part of it, and you rightly said that that it has to be on interest rates and cash flows, but it is usually lesser than the face value of debt itself, right? Now, there's another theory that people say that you also have to use the option valuation model, where you say debt plus the value of the option has to be considered as a fair value. Now, to have the option valued itself, you need to have a strike price or a base value. So again, you have to do valuation of equity, then do option valuation, and then do a debt valuation. The problem is that a lot of time the client says, when the 13(2)(h) specifically says to me that I don't need a valuation report as of now today, why are you valuing my equity? That becomes a problem. How do you value debenture itself, convertible debenture itself, without valuing the company's equity?
Exactly. So that's why the point to, not to do valuations will be a better deal rather than putting up a valuations and not, doing the option pricing and the different scenarios, because every convertible debentures will have a option or not. If it is not compulsory convertible, if it is compulsory convertible, then it is fine. Then it is fair to have a fair face value only. But otherwise, it may have some element of the option. So we may have to do those valuations. Otherwise, it's better to have a not to do the valuations and completely forego it for that same. That's my view. That's I keep it open for your comments and feedback.
Actually, Mr.
Another
Nishant,
problem-
in the context of time, while the questions are all valid, yes, the doubts are, all of us are struggling and grappling with the same question. To interpretation, yes, it's happening. You can proceed with your session because it's already 8:30. Whatever you had thought in mind,
Right.
for today's, please go ahead with this,
Right.
with your session.
Okay.
So, ma'am, please ask them to refer that rule 13(2). It says clearly that either the valuation can be made upfront or afterwards. The rule is clear here. The amended rules. I have posted in the chat also. They can
Yes,
refer.
yes. Sir, the audience is
rule is
aware
for the
of the rule,
resultant
which is
security.
actually creating the confusion practically. That's their doubt. Sir, Mr.
So
Nishant,
that rule
please
is for
go
the
ahead.
resultant security, sir. It is for the resultant security that we understand. But what about the security itself that is getting issued? That is a problem. Anyhow, we can move forward.
Yeah, Nishant, please proceed.
Sorry. So discussion will keep going on. So in meanwhile, just that for startups, there's a separate thing called convertible notes. Typically, from valuation perspective, when you are issuing convertible notes, we need not take any valuation report. It is not required. The only thing that I think is I want to point out is that the period defined in Companies Act 13, the maximum tenure is 10 years, whereas reading the FEMA rules, it is 5 years. So just this is like one particular point I wanted to show in the convertible notes. Otherwise, I think this must have covered in your discounting startup seminar ahead. So,
Nishant, please correct me if I'm wrong. In the convertible note, as far as when I discussed with many of the professionals, there are two approaches followed by especially company secretaries. Okay, one is totally treated as debt, as if you're taking debt, follow everything, maybe just a board resolution is sufficient.
Right.
Another person says, no, convertible note is a security. So follow everything as if it's a private placement of any other security. So follow private placement, identify the investor, and then proceed. So which of that is your choice? Board meeting vis-a-vis private placement offer?
The first one, but you need not have a valuation report because this is purely treated as debt.
Yes,
this
yes.
is very clearly written in the DPIT also, and in Companies Act 13 also about the notes for convertible notes. So we need not take any valuation report, and it is simply that treated as debt.
And no conversion is normally agreed as market parlance.
Yes.
Only interest is agreed.
Correct. Correct. Right.
Proceed.
So convertible notes agreement can be made and you can define it in more detail. So follow that also agreement. Venture debt. So again, this is like a more informative part. So I may skip this part and jump on to other segments.
Debt, no, nothing specific.
Nothing specific to valuation. We don't need valuation. It's just a way of funding that a startup gets. So I said startup gets funding by equity and debt. So venture debt is one option, and it is typically given by venture capital investors only. So there are different types of ways to raise debt for venture.
It's not even convertible, right? Or is it convertible?
It can be hybrid. So instead of convertible, they can even issue share warrants, and then share warrants can get converted into your equity at a future date whenever venture capital wants. So typically, when this kind of debt comes, it typically comes with equity. It is normally for Series C, Series D type of companies usually. Usually, I mean, they are raising such big round. So at that point of time, equity plus debt structure is what been announced by the venture capital companies. So even in Baiju's case, like debt was also equally funded with equity. So that's how they started created problem with debt, but separate story. But in short, the debt may be very hybrid in nature. So it totally depends upon the terms and conditions on how you are identifying the company, the nature of its business, the growth potential, etc. Based on that, you are given a particular type of security which is suitably tailor-made for a particular the startup. So it is hybrid, but in some cases I've also seen that interest component they are taking in share warrants. They are asking not to pay any interest. Interest is defined, but whatever would be the fair value at that point of time, at the end of the year, they take share warrants from them and they convert into equity at a future date to avoid interest burden on the startups. But from valuation perspective, we are not valuing venture debt. Right. So moving forward, prerequisites of startup funding. So this I can cover in very from valuations perspective only I will cover. So there are basically two types of requirement. One is from investor side. They have a requirement before investing into a startup. Investor has certain checklist, and regulatory also have a certain checklist. So what are investors checklist? So they just want to check that it's a startup recognized startup ESOP quota is there. Due diligence, financial modeling, and pitch deck is present. IP is generally not registered if it is registered in name of founder. So better they ask before investing that you convert this IP into the name of the company, and then a shareholder agreement is prepared. Now ESOP. So ESOP we already had a very detailed discussion before, but this is something that I wanted to highlight that existing shareholders are the incoming shareholders are also concerned about their dilution part. So that's why they ask ESOP pool to be created before only. Okay, so that is from investors' perspective that they don't want further dilution in their stake. So if they're negotiating for 10% stake, I want 10% stake in your company. So it has to be post ESOP pool. So that's how the cap table is prepared. Okay. And from regulatory point of view, what are the requirements? So I think only a couple of things. One is valuation report under whatever acts it is required. Income tax, FEMA, Companies Act 13, and then authorized capital has to be increased. You have to check this. And if it is some regulatory approval is required, like FDI approval is required in for approval route, then you have to take RBI approval, etc., SEBI, etc. Okay, so quickly we jump to startup valuation methods. So one point I would like to clarify, valuation standards are prescribed to us. A couple of valuation standards may be applicable over here, but that does not mean that these methods, what I am presenting over here, is a replacement or a substitute for valuation standards. No, in your practice, you follow valuation standards only, but this is only, an art to derive the value of a startup. So these methods typically are not in valuation standards, but it is a way of thought process, thinking process about how investors think or the founders think to value their company. So this is what we intend to present.
So, Nishant, actually, I understand this is a part of my ideology, thought process, and it will be in working papers. I got that. But can I also add somewhere some line in my valuation report also?
What do you want to add?
About the usage of these methods and how I got,
See, to be very simple, if you are giving a report for a regulatory purpose,
no,
suggest don't write it. Valuation standard is mandatory. If you're doing it for internal purpose,
value discovery.
Yes, value discovery projects, you can use these methods, no problem. Right? But when you're making, you have to fit into DCF or market comparable something. So the first method is dilution versus capital raise. The concept is clear that this is in simple words termed as a negotiation factor. Negotiation means I would come as an investor and see you have a startup. Okay, I am ready to infuse some money. I want 10% stake. So without knowing the valuation, I think sometimes the promoters agree, but it is not always the same way. Even in matured companies also this happens. But we believe that the person who is offering or the person who is accepting the offer always have a knowledge about the valuation. This is a general assumption into the market. So you cannot purely say that venture capital companies don't apply their brains and just give any offer, any damn offer. So they do apply some brains. They do have some backups, and we've been seeing some of the episodes of Shark Tank also where they've been offering something. So they have some calculation behind it. They're not simply offering it, but even after that also negotiation also happens. So yes, I know the fair value of the company is 10 crore, but in case I can get shares for 8 crore rupees, I would be more happy. So that's always a negotiation factor happening. So it depends upon the founder whether he's ready to accept this funding or not, because it is critical for him. Sometimes it at a zero cash situation. Sometimes he might have some different strategy that, onboarding this man would really help me to diversify my business or get something more. So he may compromise. So depends. And sometimes it is vice versa also, that investor is compromising. So this is purely based on dilution versus capital raise method. So it's purely negotiation method. And many VC companies have also seen that without applying the brains, if you are a pre-revenue stage or you're looking for funding, they directly fix up a valuation of 5 crore rupees fixed. So you want and they'll raise 50 lakhs for them. So the dilution is accordingly calculated 11.11%. So whatever it is, I mean, it is pre-decided by them. Okay.
Actually, this pre-deciding, I'm really confused. Law says you go for a valuation report, then go for a shareholder, then go for, identifying the investors and send it. Okay, somehow, in any other startup, maybe they are not that evident that the certain price is agreed. But then in a Shark Tank, wherein it is, it's too much evident when the episode raised, when did it happen and when did. So as a valuer, if I'm signing any report wherein, sharks have already agreed at a value, and then every time, maybe me this time, maybe you next time, how come the valuer, it's like anyone can catch you, like, value was decided, you are matching it up. So
Very
how
good.
as a valuer we can protect ourselves is something which always.
Yes, very good and very practical question. So typically what happens, the negotiation happens where a valuer is never present in the picture.
Yes.
Right? Directly, I mean, we are just watching Shark Tank and the negotiation is happening over there. We have no role to play. And then they directly come to us that, hey, I want a valuation report of 10 crore rupees. What is this, man? I mean, you've negotiated everything. Yeah. बोले कल पैसा आने वाला है, दो रिपोर्ट दे दो. अरे, that's a practical situation. But then, as a valuer, what is our responsibility? See, market will create its own thing. I'm saying law is also correct, but it is at the end market who is acting on all such things, and based on market performance, everything, the law may keep getting updated over a period of time. So the point is, if they're saying I'm investing a 10 crore valuation, as a valuer, your responsibility is to check whether are you sure you are getting a 10 crore valuation. See, if the valuation is coming to 4 crore, 5 crore rupees, it's still okay because you are issuing at a higher price, which is allowed in the Companies Act 13, and you are okay to issue over and above fair value as per Companies Act 13. Income tax has a different challenge. I'll come to it later. FEMA also is okay from regulatory perspective, that it's okay if you're issuing at a higher valuation. Income tax, again, it should not be a problem because normally this happens in little small type of companies more often. And in that case, if your company has filed Form 2, then they can claim exemption. That's I think angel tax exemption is available to it. So from there also you are protected. So when you are valuing it, you are getting a company's value little lower. It's okay. I mean, you can take the risk of issuing a report. Okay. But practically, if your value is coming quite high, then you have to look into some other parameters also apart from financial ways, that what strategies is coming to you and is it fair with the deal to go at a discounted value? If you think answer is no, I think suggest to your client to avoid this deal very clearly and tell him look for some other investors, but this is actually compromising your things. Okay, ideally this is like we can only have a discussion with the founders, we can have discussion with the investors, etc., and based on that we can come out with a solution. Otherwise, give them option of issuing convertible notes or some other convertible securities which may have a future date conversion, etc. So these all things can be considered, but then you have to change the instrument. So these are practically things what is happening.
Not even Shark Tank, a lot of term sheets are being shared earlier than the valuation report itself has happened. So that also creates a problem because now you have a negotiated price for equity in paper, and how do you ignore it? That is something out of the picture. And a lot of time, founders also want to match the valuation. They say, "Give me a valuation of this much of value." It's like that is a huge challenge in the market.
Yes, that really happens. And the earlier round was already at a higher valuation, and they've compromised on the valuation in Shark Tank just because of strategies. Just because if one particular person steps into my board, it will create a lot of difference. But then also, in that case, the deal is also structured in a little bit different way. A lot of challenges comes up into picture. Anti-dilution clause comes into picture, and then if you're issuing shares to the sharks, then typically some shares are bought at the fair value, say 10 crore or 20, whatever is the fair value at that point of time, and some shares are transferred by the promoters as a sweat equity kind of thing from the personal holding to the sharks holding. So this is also the way deal is structured. So valuation is not compromised, but the way to transfer the shares is comes into picture. But as a valuer, diligently you have to work on one particular aspect, that is evaluating whether the negotiation price is going fair or not. Don't compromise on that part. That is a duty of a valuer. You will get a projections from the management, vet the projections, check the projections properly, and then act on DCF method or some other methods if you think.
Yeah,
Yes.
yeah, so one question. So sometimes the deals are structured in a way that, okay, somebody has agreed for a down round, but the founders and the investors agreed that, okay, we will not, while per se the investment is being done at the down valuation, but the deal is structured in a way that we will get 50% stake at the up valuation and 50% in a kind of advisory share. So how does the valuation and tax implication would be there for this kind of structures?
See, advisory shares is little, I can say, we'll put it into two ways. Okay. Like part A is like one part is how do you see advisory shares is that suppose I'm giving a service to a startup. My services agreed that I'm supposed to provide XYZ services and I'll get 1% equity, okay, of the company. Now, say the value of the company is 10 crore rupees. 10 crore ka 1% ho gaya 10 lakh rupees. So I have to give a bill of 10 lakh rupees with GST, okay, and they will deduct TDS and pay me the balance amount in. So GST amount they'll pay me in cash, and TDS amount again they have to pay in cash to the government. Balance amount they will whatever amount comes, so that amount value of shares I will get. In that case, I have to offer 10 lakhs for income tax purpose also, and they will also get a deduction. This is one way of advisory shares. The other way is the easier way. The promoter directly transfers 1% of equity shares from his account to my account. All the investors are not concerned because the dilution, etc., things are not affected at all. Okay, so these are like two ways in how advisory shares is done. So most common is promoters directly transfer to avoid compliances burden, etc. But then yes, it's a loss to the company because the company is not able to book the expenses whatever the advisor is given.
But so, in that case, a lot of income tax implication would be there because
yes.
first, if you are raising the invoice, then you have to pay 30% tax, 30-40% tax on your income. And correct. Second, at all, if you are getting the share from promoter, then also since you are investing in a company at the same point of time, the income tax authority would consider that as a fair value and would consider the gift tax in your hands.
So the transfer typically takes place at 11UA valuation.
No, that is okay, but at the same point of time, the company is issuing the share at a fair market value. Then income tax authority would consider that this is a fair market value.
No, issue and transfer both are different, right?
No, both are different, but 56.210, what they are saying is that if you are receiving anything, the fair market value and the consideration, the difference is more than 50,000, then you have to pay. So income tax authority might trigger that this is the fair market value, because at the same point of time you are investing, and the registered value report is also available for the fair market value for the issue.
No, 56.210 is giving reference for 11UAs that 3, na, that A plus B plus C plus D minus L. To that method only it is giving reference to.
That is a bottom value. That is a bottom value that you cannot do below that price. But anyways, income tax authority can consider the fair market value.
No, is it possible, because rule 11 is that is the requirement for around the valuation. It cannot be a bottom price. That is a FMV, no?
No, sir, it's a bottom value. So basically, you cannot do at the below that price. But so I have seen many instances that income tax authority are triggering the notices. But at higher level, so you might get the relief, but the lower level authorities are not even accepting this kind of.
No, I mean, the law is clear that for the purpose of transfer, it is the floor price which is considered. If there is any transfer below the floor price, then it will have a tax implication.
Exactly, correct.
If the transfer is above the floor price, then there is no tax implication. The rule as well as the law is clear.
In any case,
if there are any
applicant tax.
Yeah, so I mean, like for time being, we can conclude that that's the bottom value which has been given by Rule 11U, and practically that is what happening in the market, that they're transferring sweat equity shares at that level to the investors. Okay, in startup world, this is what practically I've seen. Okay, so 11UA valuation, where they transfer, the investor transfers money to the founder, and then he obtains shares.
Can I ask a question?
So, yeah, please.
See, whenever we talk about this valuation, this question is purely from a tax and regulatory perspective.
Correct.
Whenever we do a fair market value of a share, is that a fair value for an unencumbered, free-flowing, independent market price of one particular unit of a share? Is that how it is? That's how it is, right? With no ambiguity.
Can you repeat? I didn't get your question completely.
I'm actually carefully repeating so that I'm trying to frame this question.
Okay.
Whenever we say fair value of a share from a tax and regulatory perspective, the value of that share is essentially with no restrictions, unencumbered, free-flowing, tradable commodity of one unit of a share. Correct statement, right?
Correct statement, yes.
So in the startups, when we are talking about investors coming in and they're saying that they are going to give at this particular valuation, so on and so forth, we know that there are so many covenants that are put up in the agreement between the investors. The covenants actually give so much control to them that if I were to reduce if I were to value those covenants, then the value of the free share is much lesser than whatever is the price quoted. Correct? So from a tax and the regulatory perspective, what does the valuer has to report? After reducing all the covenants and come to that particular price, and this is the price at which this investor has come, not the price on paper what is shown after adjusting to this. Is that what is to be considered from an income tax?
In regulatory purpose, it is simple that you have to follow valuation standards. Valuation standards say that you are supposed to follow DCF, market comparable method, and net asset value method. Okay, so typically these are things followed, and the way the normal valuation is done, the same way the startup valuation is done. There's no specific adjustment made towards anti-dilution clause or some covenants, etc., which is written into the SSA or SHA. So specifically, the market is not giving any discount separately to it.
Which is the question I'm asking.
One particular thing discount is given is only for lack of marketability of shares. So discount for lack of marketability is basically that your shares are not tradable into the market. So you only give discount for it because these are unlisted shares.
So which is the question I asked? The
Yes.
particular tax and all this, whenever we talk about the fair value of a share, those
Yes.
are free shares, which has no restrictions, unencumbered and absolutely tradable. So whenever we are talking about such kind of a startup investment value where per share value is derived, they are not equivalent to that free share. So unless you do those adjustments of the registered value, how can you bring in say that both are the same and we just have to follow and give it?
So my point is that, the slides which I'm showing you is purely the way the market is functioning. Okay, it is not about some standards prescribed or the responsibility of the valuers. Okay, what I'm putting is purely market is following this, and based on market, now when we have to mold it to ourselves, we are following valuation standards, we are following regulatory, whatever regulators are asking us. So the only important aspect is you look the company the way you will look, I will look the way I will look. There are other people, everyone will have their own eyes to view the company. So they will look in their own way, their own understanding with the management, etc. So each and every valuer will have a different value for sure. You will give this weightage to the other factors of SSA is absolutely okay, valid. It is your perspective. Okay. So nowhere we are stopped by that. You are allowed to do it. Okay. So it depends upon your practice, how you are able to value those particular things. Those are more contingent in nature. If this happens, then this will do that. If that happens, we will do that. So these are all, I will have one more board director appointed in my company. So these are things which is going to happen. Some things may affect financially, some things it may not. So you have to convert it into finance and see how it is going to affect the value of the company. So moral history comes that way only.
Okay, thank you so
So,
much.
Yeah, thank you. We'll understand the methods first, and then, there are some 7 methods with me. So we'll complete that, and then, we can take up quickly all the questions. We have, okay, so this particular part, I think I can skip because I wanted to just focus over here that dilution will always happen to an angel investors. Many angel investors comes to us, says that we are going to invest 10% right now into the company, but subject to that, even if future rounds happen, I'm not going to dilute my shares. So I think since all our values over here all agree that the dilution will always happen. So as and when new round will happen, so angel investors here is 10%, it will come to 8.5%, 6.8%. So dilution will keep always happening. So maybe I'll just skip this because this is not pertaining to valuation method. In case anyone wants, I can take it up. Huh? So I'm going to the next method, venture capital method. This is how the venture capital looks at it. So again, nowhere mentioned into this, nowhere mentioned by the standards. So let us actually skip the things, directly come to the illustration part. By having an example, I think things will be very much clear to you. So it's a hypothetical dining app company. Okay, something like Zomato type of thing you can consider. So application of venture capital method is to determine the investment value. That is the steps that I need to follow. So what information I have an exit plan. When there's a discussion happening between a venture capital company and the founder says that I need to exit from this company. I will exit, aiming to exit this company in 5 years time. I'd say 5 saal baad, I will exit. Okay. So once I exit, what is my sales projection at that point of time? So he says that target sales would be about 17.5 crore in the 5th year. Okay. So that's like one exit plan information given to us. That's the VCs asked for. The second thing is valuation basis. So is there any comparable available? Say yes, it is available. So what's the value? So the comparable listed company or something is available valued at 20x price to earning multiple. So whatever is my earning multiple, uska 20x is my value. And what is my profit estimate? The profit estimate is ABC Limited anticipates an annual profit of 3.75 crore at the end of 5th year. So these are the valuation related information available to us. So we have exit plan, we have valuation related information about comparables. Now, what is my company's detail, like how I need funding into the company and who and when are going to enter when. So the table says that angel investor is going to come immediately with a 5 crore investment. The expectation given by the angel investor says that I need 50% return. Minimum I need 50% return. Then VC1 comes into picture at the end of year 2, and he says I want 5.25 crore return. I'm going to infuse this much amount, 5.25 crore with a 40% return of investment. Same way, year 4, another VC is going to enter with 7 crore with 35% return expected by him. It's 35, 25, I cannot see. I think 25 should be. Okay, so these are the like information given to us. Now, how do you calculate this by venture capital method? So step number 1 is find out your exit price. So my exit valuation projection, I would say that profit in the 5th year into my 20x multiple, right? So that is 3.75 crore, which is my earnings in my last year into 20 times, which gives me 75 crore valuation. So my exit value is fixed today at 75 crore rupees. That is my anticipation. That is the venture capital's anticipation. Now, the angel investor says I want a 50% return, right? So he's putting up 5 crore rupees at initial year. So let us discount 75 crore rupees to present value. So if I want 75 crore value at the end of 5th year, so what is my value today with 50% discount rate, because that is the expected rate of angel investor. So this comes to about 9.87 crore rupees. Okay, I'm discounting it, compounding annually, coming to 9.87 crore rupees today. Now, if how much equity I need to give, I have to decide on that part. So today my value is 9.87 crore rupees. I am putting, angel investors putting 5 crore rupees. So accordingly, the percentage dilution is 50.65%. Okay, so this much percentage of stake angel investor is going to take. So keeping it simple, what is pre-money and post-money valuation? So post-money valuation is my 9.87 crore rupees. That's my 50.65% stake today, valued at. I am infusing 5 crore rupees. So if I reduce that, 4.87 crore becomes my pre-money valuation. Please tell me, did you understand?
Yes, sir.
Thank you. I'll keep it slide open for another minute, because this is the thing that we need to come here and learn. So venture capital method purely keeps focus on exit valuation. So what would be my exit at a future date? I am discounting it today to present value is my post money valuation, and whatever investment I am required to put and my expected rate of return that an investor is expecting on his investment is analyzed, and based on that the valuation for venture capital method is calculated.
Normally, angels expect like this, isn't it?
This is angels expected. Angel or see, it's a venture capital method, so that's why I was coming way. But
this is normally 20-30%, 20 to 30.
Yeah, so I mean the example says 50.65%, but you can ignore that. So it's just a hypothetical example. But yeah, generally, typically, earlier 10 to 20% is dilution. What angel investors looks into it, but their expectation is something more than 25%. Actually, angel investors' expectation is much higher, 30-40%, because they are coming at a very, very early stage, typically. But then depends person to person. So whoever is valuing it, he will tell his own perception that, yeah, this is my expectation. Alternative place, I'm able to, earn 30% return. So at least I want 35% over here to come.
And I have seen certain negotiations wherein the angel insists on his percentage, say 10% dilution. Okay. So initially the angel will get 10%, and then it remains constant for 1 year or 2 years, some time limit they fix. So irrespective of the funding round which happens, still they continue to hold 10%. So either the conversion price is readjusted or the promoter gives from his, or the existing shareholder, whatever is the arrangement. But I have seen, this kind of arrangements. Maybe the promoter is desperate for money, or he's a start, whatever. But I have seen these agreements.
Got your question. So two possibilities. One is with every round, either angel investor is participating in that round to keep his share constant. If
he is not participating,
he's not
very atrocious clause.
Then only one option is that the promoter has to transfer shares to angel investors.
It's very atrocious, but promoters sometimes accept this kind of clause. So somewhere I feel, the promoters have to understand that a professional intervention about reading the term sheet, making them understand, 10% for 10 years, 1 year or 2 year means what?
Correct. So I actually skipped this slide. This is what actually I wanted to show. The angel investors shares will always remain constant. So here in example, 90,000 shares are there. ESOP 1,000, founder 89,000. So 90,000 shares were there. 10,000 shares were issued to the angel investors. So 10,000 shares will always remain constant for angel investors, but his percentage will always come down from 10% to 8.5 and 6.8 whenever new round is happening. But at the same time, if his number of shares is same and his stake is coming down, with the valuation always getting increased. The valuation was 10 crore post money, and then 20 crore, and then 150 crore rupees. Okay, and they've raised good amount of money. So about 34 crore has been raised in this 150 crore valuation. So on that basis, the value for angel investors always increases with every round. So he always have an appreciation in the value, but his dilution may come down. So this is what I just wanted to explain by this slide. So maybe you can use this slide to explain to your clients or founders that dilution has to happen.
Yes.
Right.
Promoter should consult us before talking to the investors or negotiating with them.
Certainly. Okay. So moving to the third method, this is purely a comparable transaction method. So typically in startup, there is only one challenge. In case you're a pre-revenue, then it becomes difficult for you to value. So in pre-revenue, what are the options available to? So post-revenue, we understand that, okay, there could be sales multiple, EBITDA multiple. I can make some adjustment with respect to debt adjustment, something like that. So maybe I'll consider EBITDA multiple, and then I PAT multiple. So I have some options available if companies into some business. But if it is pre-revenue, it becomes very difficult to use this method. So what is the option available, or how does the startup industry looks to value pre-money companies by comparable transaction method? So they typically look for some traction or KPI, key performance indicator for the company, and they compare it with a similar another subject company at what valuation they are trading at, and they apply the same multiple over here to our company, and accordingly come down with a value. So let us
here one small question.
Yes.
See, for example, if I'm taking revenue multiple, EBITDA multiple, whatever, I have MCA data to back up. But KPI related valuation is something, maybe I have to rely on Google itself. So can I say that, this was the KPI of this company here, and then they have a valuation round at certain time? Because all this, even if you see the, some analysis in Google, can I rely on my valuation on that KPI related multiple of valuation?
So I think
where do I get that?
It is, to be very honest, a difficult task to find out a very comparable method. So how you can actually perform is if you have got certain subscriptions, so you can get some data about that company, about how many users are present. Like if it is listed on Google Play Store, you need to find out how many people are already using
that. Okay. It's an interesting point. Always we are thinking of Googling or subscribing to some softwares, right?
Correct. So there are even some research report companies which give some information like, traction is there. Private Circle also sometimes comes out with some companies report. So in that case, we get some additional information about it. that the company has got X number of traction or Y number of traction, some information we get from there. So maybe Google may not be the very right way, or even the competitor company's website may be still okay, but if somebody else is giving information informally, I think we cannot accept that. So I think fetching of information is very important. You can even use some other sources like the follows on Instagram or YouTube channel or something like that on social media platform, and take an idea about how big the company is, how better comparable it is. So even finding whether it is properly comparable or not is important, and they might be present in 10 business, we might be present in 5 segments of the business. So comparable is again like not very properly going to happen. So every startup is going to show different from its competitor when they have to survive. So challenges is huge, but you have to look at some more things wherever possible. Okay. In this case, let us take an example. So a key performance indicator. So this is a below an assessment of a hypothetical pre-revenue online self-publishing platform, illustrating the application of comparable transaction method. So here, key performance indicator of startup. So in this particular company, the number of monthly average users is 110,000 users per month. So similarly, there is another company who is valuing at 20x multiple. So I am using that number. So how I've got that number is pre-money valuation of the last round, whichever has happened, and monthly average users, which I was able to get the data. So that comes to approximately 20x. So I am valuing 110,000 users into 20x multiple. So is the value of my company. So definitely fetching information is competitive, but that's the so when you see from venture capital angle, they must have looked out into similar kind of companies, so they are in excess of data. As a valuer, we are restricted to the data unless we are doing valuation of similar kind of category of company. So for example, if you're in defense sector, again defense has like multiple lines, but if something common comes out of it and you have done valuation for other company, maybe you can even use that as your own, because you have your own database, so you can even use that data if it fits. So even don't forget yourself before Google. Okay, so moving to the another method is discounted cash flow method. So I think this is what normally we all follow, and I would not take much in depth of it, but the concept is simple that a cash flow or a projection is given by the company, and we estimate a cash flow and then calculate a free cash flow for it. Then we apply the discount rates. Based on the discount rate, we get a value. We can calculate beta, so levered beta, unlevered beta, these all things you might be aware. So we do all these things, and based on that we get the cost of equity. So again, I mean, I'm not elaborated much in detail. FCFF is one option, FCF is one option, so depending upon things you can consider it. The only last thing is terminal is also clear, and if so this is the adjustment of probability of failure, which is generally taken as one step more in DCF by the VC companies. So they say I'm getting two values. One is if I'm a value of a going concern, I give a probability. Say 30% it will continue to great extent. But if it does not, it becomes a distressed sale. Then what will be the value for the distressed sale and the probability of failure, which would be 70%. So typically these values been added and we come out with the value under DCF method. So again, this is open method. These are just about applying your minds. So probably, this could have even answered one of the questions about if DC startup has a lot of challenges. So if like 10 things are more written into the agreement, so maybe you can even give some weight over here about the probability. If you think that would result into probability of failure, you can give some weightage over here and address your value or minorly adjust your value over here.
This probability of failure is for the entire enterprise value or only for a terminal value?
So can you repeat?
Mr. Soni,
Can you repeat, sir? Can you repeat?
this adjustment for a probability of failure, we need to consider for the entire enterprise value arrived or only for terminal value?
This is for the entire business value, the value of business.
Okay, you mean to say if there is any concern that the business will achieve its expected business value, then we need to consider this probability.
Correct, sir. So DCF, sir, DCF typically takes into consideration that going concern is going to be there, and you're going to, keep generating profits, cash flows, etc., and you're going to continue for infinite period of time. So it never captures the failure part. Okay. So the thing that venture capital companies are trying to address is maybe as a negotiation factor, this will actually reduce the price, because in any case, the projections made by startups are too fancy. Okay. And that's why they say, okay, if everything goes well according to you, then this is the value of the company, but I find only 30% probability that this will be a successful thing.
Okay.
But in case it is a failure, then what? Then I will have another value of distress sale, and based on that, I will have a value that in case today or tomorrow I have to liquidate this business by selling my IP, by selling my assets, how much amount I'll get. So that's my distress sale value adjusted with liabilities, etc. So into probability of failure.
Oh, got it. Okay, thank you.
Right. Then we have first Chicago method. This is by name looks fancy, but it is very simple. It is typically a DCF method only, but the DCF method is instead of making one DCF, we make 3 DCF over here. The 3 DCF is worst case, normal case, best case. Okay, so by putting this simple DCF into 3 formats, we get a value for the company by assigning probability to it. So let us see an example. In simple way, I have calculated 3 value by DCF. Worst case scenario 1 crore, normal case 10 crore, best case 20 crore. So I have given a weights to it. Again, the weights is flexible. It is just for representation purpose. Some weights have been assigned, but depending upon the valuer's point of view on various aspect, you can think about. So valuer mean here over here it is venture capital because they are using this method. We are not using this method, but the thinking on strategizing how they can strategize things better or elaborate things in a systematic way, have a standard operating procedure, etc. So they can assign some weights to it, and you get a valuation probability number. Summing it up, you get a value of the business, and that's like one of the way to value a business. So first Chicago method is simple: 3 DCF, worst case, normal case, and best case, right? Then we move to another method, that is Burkus method. So Burkus method is a very straightforward valuation method. So it's like not giving focus on the numbers, but on risk factors. Okay, so probably more applicable to pre-revenue companies, because Mr. Dave Burkus says that pre-revenue, I do not trust projections, even discounted projections. So he come out with another method, and which is being widely followed by VCs also. So they give importance to certain aspect which cannot be actually valued in terms of money in a real way. So they say that, okay, I have a benchmark, say if it's a pre-revenue, so my business value has to be comparatively low, but it depends. Sometimes even a space tech type of companies has a very high value, so maybe in good amount of crores. So depends again upon the benchmark that you're setting for it. So valuable business model. So he's giving focus in his notes. He has given focus to these particular 5 things, which according to him is important to evaluate a startup. So he's focused on business model, prototype, the founding team or the management team, strategic relationship, existing customers or first sales. So these parameters are being analyzed independently by the investor, and based on that he gives some value to it. So the value could be depending upon the business model, the prototype, etc., these factors, a value has been assigned, and totaling to it, we get a value, and probably that is a value business by Berkus method. Now, there were some, pros and cons in these methods. So the upgradation of Berkus method is a summation method, which says that Berkus method is okay, perfectly all right, but it takes into account only 5 things. But there are, n number of things which can affect my value. So hence, it's a risk factor summation method, which is an upgradation to Berkus method. It is used by angel investors for determining pre-revenue startups. So what does this method takes into account? This says that there are, at least 12 risk factors which has been identified, but as a valuer or as an investor, you can still keep adding some more risk which you think is essential in your business. So they've identified risks like management risk, stage of business, legislation or political risk, manufacturing risk, sales and marketing risk, capital raising risk, competition, technology, litigation, international, reputation, exit value. So they have identified some more, type of risk, and it is like a scorecard method type of thing, that these risks is again being evaluated with some parameters. So for example, let us take an example. So I'm giving a rating of from 2 to -2. So it is, if it is extremely positive, I'm giving 2 points. If it's neutral, I'm giving 0. If it's extremely negative, I'm deducting -2 points. So I will adjust this money from my valuation from the other methods which I've derived. So for example, for Chicago method, we got 9.2 crore rupees example, or in this case example, 8 crore is the valuation which I've got. Now I'm adjusting all this risk. So whatever risk I could identify into the company, the points have been given to it. Based on the points, I've made adjustments by adding this much value to my valuation or reducing it. Okay, so say management risk, I've given 2 points, so I've added 50 like as a value to my valuation. So my startup valuation is coming to 8 crore rupees based on any other method, maybe DCF, maybe market comparable, maybe Berkus method or venture capital, any method you name. So by other method, I've got value of 8 crore rupees. Now, these particular risk factors, I am adding these adjustments to bring my pre-money valuation. So this is how the valuation works in particular risk summation method. So I think that's it. With respect to startup method, we have covered all the 7 methods, but just a couple of things more. Venture capital investors often value newly born companies on a multiple of proposed or existing earning EBITDA. Probably this approach is flawed in the sense that it applies constant multiples to all the entities with different characteristics, but similar revenue or EBITDA. This approach completely ignores the fact that most of the startups don't survive, and this risk of failure is not at all built in the model. So multiple is usually calculated on the basis of data of mature companies without alteration, adjustment to make it specific to startups. So this is like, a flaw in the model or the way you look at multiple based valuation. Typically what we see in very practical circumstances is that if any revenue multiple is been identified, say 5x multiple, X company is trading at 5x multiple, or it is being funded by some VC at 5x multiple of revenue. So the probability factor of success or failure is always ignored in these methods. So probably as a valuer, we can be alert and we can always speak out, but it's the market which has been following it, and that's how the startups have been valued. So that's why sometimes even bubble comes up in your valuation. एक दिन फुटेगा ये bubble. So similarly, one point that I just want to bring into picture or highlight is the preferred stocks. So they are sometimes optionally convertible preference shares. Some of the investments in startups are made in that particular form. So mistake is whether it is some of the values take it fully dilutive, some of them take it as a debt. So it like is taken on the discussion with the management. They feel that okay, it's optionally convertible. Management, what do you think? You'll convert this or you'll repay them? They will repay them. So taking his debt and closing it. So maybe this may not be the very right approach. We have to treat it like it has been explained in Ind AS. I mean, going into a deep explanation for this would be another session. So the point is I'm trying to highlight is that option valuation is separately treated and it has to be brought into effect into our model is a suggestion from my side, if that is possible by the valuers.
So as a valuer, we have to go for Ind AS option valuation method for this.
I think so, because that is the best way how you can value the debt. That is something. So we also have 302, right? That is 301 or 301, I think. That is financial instrument valuation standard number I'm talking about, issued by ICI RVO. I don't know about other RVOs. So in case, so the treatment is already given in the valuation standard. So you can follow those. It is similar to Ind AS. Okay, so you can follow that treatment maybe when you are valuing optionally convertible preference shares in your financial model. That's all from my side. So these are some terms which are commonly used in shareholder agreements. So maybe it may not have impact on valuation, but probably the sir was pointing out that these are some rights. So are we required to adjust or not? Is a question, but most of the valuations are done at a very high valuation only because they want to see multiplication happening. So multiple things happen. The politics also exist in venture capital company. They also have a target to invest in X number of companies. So sometimes even they compromise. So multiple things happen. So it's at the end the market and multiple forces plays role into valuation. So, but these are some common points, typically some rights. I've just given for representation purpose, but does not have impact on valuation as such. And pitch deck, maybe I'll just share this to you. So these are some areas which we include in our pitch deck, but I'm not covering pitch deck right now in detail. So I'll just skip this slide, and that's all from my side, ma'am. The quote is important. Valuations can vary, but values are forever. Please be in your ethics. Please follow ethics. With this, I would like to thank you everyone for the session.
Anyone has any question? Actually, Nishant, I had a question. Okay.
Please.
I'll just share my screen.
Okay, I'll stop.
I hope people have made a note of this. I'll just wait for 2 seconds before I share my screen. Nishant, this is the age of AI. Okay. While I feel ChatGPT, while using ChatGPT, I may not get the source of the data where from the ChatGPT is picking up. So Copilot, I have this recent laptop, so it's enabled in my laptop. So just Windows C and then my Copilot starts. And while doing valuation, I asked Copilot whether, what is the value of a health tech company? Give me the revenue multiple. So, I'm just trying to, throw light as to how we can or we should not do it. And then it also gives me, comparables. What are the comparables in this, and while I say it gave me a revenue multiple of 4.5. So I asked Copilot, what is the basis of this? Why did you give me this and where did you give me this? So it gave me this one, looks like, it's some health tech M&A newsletter from Nelson Advisors. Okay, so I'm just throwing light, maybe, if the valuer wants, they can also use AI for this, and the system, the Copilot has taken it from here. What are the different health tech companies and how it has taken, and there are some other websites where it has.
No, my question is: this is for India or like some other geography? I'm not sure.
Actually, this looks to be not Indian. But then my doubt is,
so this is the problem I had. Yeah. So Shilpa, when I use any of these, I get only US metric. Indian
So
metric
how
is not easily available other than our own interpretation when we fetch it from Crunchbase or any other website where you can actually get the valuation board.
That's my question. Like, can I rely not, how, but in fact, to be, many people say, okay, we are aping Western, we are following their Silicon Valley there, how is, as a valuer, should I just ignore it, or can I take something like this?
So see, some or the other database is always available with you, but the thing is, the source has to be reliable. You should know the link from where it is coming. You can download it and you can share it with someone. So that would really matter a lot. And I am sure over a period of time, the technology play a very major role in calculating your deals, but there are already some softwares available with us. So let us first try to explore that. I know it is an investment for the valuers to invest, but I think it is an essential for us to be dependent on such softwares to get some more data, because we are still restricted with valuation part. Uh, to be honest, what overview I've given you is something that the market is following a market's perspective, not a valuer's perspective. So valuer has to work hard to fit into market. So to satisfy the market, there is a need that we get more database available for us. So in our context, indirectly, that's how we follow that. Indirectly, we're connected with VC companies, and we even ask them for their some companies in that particular segment, and please share your pitch deck, because I'm an angel investors. I do get access to some of the pitch decks, and I sometimes even take comparables from there, because it's a reliable source and investors are vetted, and that's been claimed by the management. So, but I mean, that's a indirect way of getting it. It's not official way, but the high time that we have to, find suitable softwares which can help us to derive such kind of data. Still, many people are dependent on Shwat Damodaran for multiple things. So we have to do it ourselves, and how we have to do it is something we need to work out.
Shilpa, I know you like databases. I'll give an example to you so that you get familiar. Nike, Puma, these guys way back in 90s, they have done the estimate based on US pattern that every household loves to have one tennis shoes, one walking shoes and all. And they established their setups in India in a similar pattern, miserably failed. So the databases softwares are a function of, finally what are we trying is what is the money that one is going to make, the demand that's going to generate. So the pattern of the user consumption, unless we define that is similar to in India, that metric cannot be used in India. We need to look at that as the reference point, then the metric direct, then remaining follows up.
Thank you, Mr. Nishan. I request Mr. Chandrasekhar to convey formally vote of thanks on behalf of Bangalore Valuers Association.
Thank you, Shilpa. Mr. Nishan Soni, I think we thank on behalf of our Bangalore Valuers Association, very excellent session on this fundraising landscape through our startup valuation. You covered the session, though it is all known thing. You started from the startup definition. So from end to end, you covered all the startup impact, its requirements under the Companies Act and also Income Tax Act. What are the various models for startup valuations? I think session, you also address all the queries as and when the queries have come. That session was one of the another best session. Thank you for your all best efforts, and we also thank participants as a token of our appreciation and recognition of your effort. We are on behalf of BVA, we are giving memento. I think Shilpa, this will be courier to the speaker, no?
Yes, our admin will be in touch with you. She'll courier the memento for you.
Yeah, sure. Thank you, Mr. Nishant, and thank you all the participants. I also thank BVA for organizing this excellent session. Actually, this is an area of where the lot of startups and also this new era after new election. No, I think economic factors are yet to be going to be take a new dimension. So at this age, we are also taking new session. Thanks one and all for this joining session. Thank you, Shilpa.
Very much.
We'll log off.
Yes, thank you everyone. Have a good day. Neela, I'm stopping this recording.